Hope everyone's doing well and had a good trading day. This is the Emini review for Thursday, June 13th, 2024. And because tomorrow's Friday, look at the weekly chart first. And you can see the market has been in a tight bull channel since November of last year. And we had this trend line break by the bears, and that was good. It was strong, and it was a test of the moving average. But the retest of the highs is stronger than the bears would like. This is a fairly strong rally. Plus the signal bar for the sell, it's a double top, it's a doji, and then the entry bar was weak, closed above its midpoint. And now it looks like the market is continuing with strength to the upside. So the problem for the bears here, they're looking for a major trend reversal. So here's a bull trend line break, retest of the highs, but the retest is too strong and there's not enough selling pressure. So we're probably not done with the upside. But because tomorrow's Friday, there's an increased chance of a trend day, and the market will typically do something in the final 20% of the bar. So if this is the weekly chart, we still have a whole day left, and the bears will do their best to disappoint the bulls by selling into the close of this bar. And if they can get it to close below its midpoint, that's great. But even if they do, it might become a sell signal bar and a second reversal, but it's still a bull close, and the bears will have to do more. And for the daily chart coming into the day, my one thought about this signal bar, so the market's possibly in an overall trading range. We're getting the bull breakout, but there's a couple problems. Possible leg 1, pullback leg 2, and the second leg, 1, pullback 2, pullback 3. So a couple reasons the traders might be looking to take profits here rather than buy. But as far as selling here, it's a weak signal bar. It's a doji, and there's not enough selling pressure in here, so the first reversal down will probably fail. What that means is if we trade below yesterday's low, there's probably buyers below. But also if we go above, there's probably sellers above. And so for the 5-minute chart, let me just draw yesterday's low. So we had the FOMC report at 2 p.m. Eastern time yesterday. Obviously volatility expansion, expanding triangle. Market's in a fairly broad and volatile trading range. And then we gapped up on the open today toward the top of the trading range and got a bear trend bar. So bar 1, bear trend bar, fairly strong bar, probably going at least a little lower. One magnet below might be the close of yesterday, which is here. And we're so close to it, and the momentum down on bar 1 is so strong, we're probably going to get there. And if we're probably going to get there, the bulls know that, so they'll step aside and wait to buy lower. And the bears will short for at least a scalp. Probably sellers above bar 1. And as far as buying below bar 1, it's a strong enough bar, it's probably going to go at least a little lower and get a second leg. Bar 2, a bull bar, so disappointing for the bears. Bear breakout, but weak follow through. And bear breakout of what? Well, it's a gap up, so the market gapped up to here. If anyone bought on the open, they're disappointed with what happened on bar 1. Now you can argue it's not really a breakout because it's in the middle of a tight trading range and it came after a gap up. That's true. But now bar 2 is a bull bar and a high 1 signal bar, but possibly high in a trading range, and after a strong bear bar, probably more sellers above bar 2. And bar 3 was an inside bar. Market's going sideways for the first 3 bars, and that can indicate what will happen for the rest of the day. Sideways price action, trading range day. What about selling below bar 3? Well, it's a second reversal. We have the gap up, sell below bar 1, that failed. Second reversal, sell below bar 3. The fact that 3 is an inside bar reduces the probability, so even if we do get sellers below, the market will likely come back and retest the stop order sell entry price, which is 1 tick below the low of bar 3 within maybe 4 or 5 bars. But probably sellers above, it's a tight trading range. There might be buyers below bar 2. But again, with the magnet, the close of yesterday right here, we'll probably get there. And then here's the high of yesterday as well. The market's we're closer to the high of yesterday actually than the low. And 90% of days break out above the high or the low of yesterday. So we're probably going above the high or below the low. Bear breakout bar 4, but immediately pulled back. So if you shorted on a stop below bar 3, bar 4 is your entry bar. Fairly disappointing, but as far as buying above bar 4, you can argue it's a high 2. High 1 above bar 2, but didn't trigger. And then high 2, but it's a bear bar, or bear close on bar 4. And you're still possibly high in the trading range. You have bulls who bought below bar 70 yesterday, and they're trapped, so the upside might be limited. And then we went almost outside down on bar 5. So there were sellers above the high 2. We got a bear bar. And at this point, we've had 3 consecutive bear bars and 5 bar. It's a 5 bar bear micro channel with the close of yesterday so close. We're probably getting there. And traders know that, so bulls might step aside and bears might sell for a scalp. Bear breakout on 6. We tested the close of bar 81 yesterday and pulled back. But the micro channel continues, and we've had 1 bull bar in 6 bars. So there's not enough buying pressure to be buying. And if this is a trading range, the low is way down here. So if we're in the middle of the range, usually better to not initiate trades. Usually better to sell high, look to take profits in the middle. Buy low, look to take profits in the middle. Probably sellers above any of these bars. I might have said this was a micro channel. That was a mistake. There's actually a pullback on bar 5. But there's still not enough buying pressure to be buying above bar 6. Probably more sellers above. And we pulled back. There's a deep pullback on bar 7. Tested the open of bar 6, and then closed near its low. So we're still going lower. The closes of bars are trending. 3 closed below 2's close, and so on down to bar 7. And that's a problem for the bulls. Strong enough leg down, even though it's a pullback on bar 5. This could all be one leg, and it's strong enough for a second leg down. And then finally a bull bar on bar 8, but it's likely profit taking, and it's an inside bar, and there were sellers into the close. You can see the tail above, so probably more sellers above bar 8. And instead, traders sold the close of bar 8. Is bar 9 the second leg? It could be. Could be leg 1, pull back leg 2. It could be 1, 2, 3, testing lower prices in a trading range. And bar 9 is a climax, and bar 8 was a weak sell signal bar, so there's an increased chance, because the market's in a trading range, if a bull bought below bar 8, they can probably scale in lower and make money on a retest. But this is tight enough down. It's a tight bear channel. Even though it's within a trading range, you still have room to the downside, and it's enough momentum that probably not wise. You never want to be the first bull to make money. So what I mean is, where have bulls made money today? Even limit order bulls, if they bought below bar 2, maybe they made a really small scalp, and then if you bought below 8, you're trapped on 9. So it's obviously easier to be selling. Probably always in short, but the problem with always in trading ranges, as we get lower, the market will flip to always in long. Follow through on bar 10. It's basically minimum follow through, but you can see the market rallied on 10 and pulled back and sold off again. So if you did buy below 7 or 8, you were not able to avoid a loss. So some bulls might just give up and look to buy lower. And it's a breakout and follow through for the bears, so some bears might sell as well. And then the market tried to rally again on 11, but quickly sold off and closed near its low. So it's a bear breakout, but possibly low in the trading range. So it's really not ideal to be selling down here. Better to sell a pullback, and it's hard to look to buy. The problem is there's not enough buying pressure. The bulls have had 2 bars, in 11 bars today. So the bulls have 2 closes in 11 bars, and neither one of them triggered the stop order above. So that's weak buying pressure. Strong enough momentum, this could all be one leg. Some traders will see it as 3, 1 pullback, 2 pullback, 3, but the reality is it's tight enough that it could be simply one big leg. 12, you can see we're testing near the low of yesterday and testing the low of the trading range and pulling back. That's mostly bears taking profits. Some bulls might be aggressively buying, but after 3 consecutive bear bars, all closing on their low, it's not ideal. Traders also don't want to buy above bar 12. If limit order bulls are not making money, then stop order bulls will not be making money. So you might have bulls start to buy below bar 12, but as far as buying above, I would not. Even though it's a strong looking bar, the reality is there's probably more sellers above bar 12. 13 triggered the buy, but it was a high one in a tight bear channel. Even though you're low in a trading range, you know there's probably more sellers above. Now 13 is a low one short, but it's at the bottom of a trading range, so there's probably more buyers below bar 13. But tight enough channel, the bulls still need to do more before there's any reversal. And you can see what happened on bar 14. The low one triggered and immediately reversed up. But that trade's a scalp, so bulls buying below bar 13, they know they're taking a trade for a scalp. They're not buying below 13 expecting a bull trend after so much selling with little buying pressure. So great bar, 14, but the context is bad. It's still a tight bear channel, and there hasn't been a meaningful trend line break. And we're actually right on the trend line, so there's probably more sellers on the close of 14 in a bear. It's a tight bear channel, which is a breakout on a higher time frame, and then 2 legs up, 12, pullback, 14. And then traders sold the close on 14 on bar 15. Low 2 below 15, still at the bottom of a trading range, not ideal, but the bulls don't have a major trend reversal set up yet. It's becoming a tight trading range down here, but again, the bulls haven't done enough, and it's probably a bear flag. The bears still have the problem of yesterday's low. They need to break out below yesterday's low. And because of what I mentioned on the daily chart, context is not great for a bear breakout. And then buyers below the low 2 on bar 16. Now 16 is a second reversal. We had a bear sell-off. We triggered a buy above 12, pulled back. Another buy set up above 16. But it's a big bar overlapping all the prior bars. It's a trading range bar. It's a doji. So buying above the doji is never a good idea. It depends on context. But in this context, you've had many bars accumulating below the moving average in a tight bear channel, not enough buying pressure for major reversal. Probably more sellers above 16 than buyers. And then an inside bar 17. Inside bars, low probability for breakouts. Market's clearly in a tight trading range. And overall, it's in the bottom of the range. And so bulls looking at this saying, it's a triangle, possible final flag. Even if we get a breakout to the downside, it might be the last breakout before we get the reversal. But the bulls still don't have enough buying pressure to be looking for a major reversal here. It's a tricky situation because it's a tight bear channel, so fairly strong bear trend, but the context is bad. You know there's probably more buyers below yesterday's low, and we're at the bottom of a trading range, so it's hard to hold short in this context. Inside bars, like I said, reduces the probability for breakouts, probably buyers below and sellers above. 18 broke out to the downside, but only broke out below the prior bar. It's still within all these bars to the left, so the bears still need to do more. By the close of bar 18, there's an 80% chance we've seen the high or the low of the day. And of course, at this point, more likely we've seen the high of the day than the low. But there's also a couple of problems with that. One problem is that bar 1 remains the high or the low of the day only about 20% of the time. and so far bar 1 is the high. But when you look at this chart, you know the market's in a trading range, and this looks like a bear leg in a trading range. Look at the bars. Most of the bars are overlapping each other, and we're at the bottom of a trading range now. The bears need to do more. The bears need to get a breakout and follow through. So the problem with the assessment that bar 1 is probably the high of the day is that this could be a bear leg in a trading range. And if this is a bear trend day, the bears still, like I said, they need to do more. They need to get a breakout below yesterday's low. But more likely, it's some sort of trading range day. And if it is a trading range day, we've had a couple bear legs in a trading range. And bear legs in trading ranges are followed by bull legs in trading ranges. And the high of the trading range could be all the way up here. Bear breakout 19. Consecutive bear bars closing on their low, but not particularly big bars. But 19 closed below the low of yesterday. That's good for the bears, but they still need follow through. And then look at how bar 20 reacted. There were more buyers below yesterday's low than sellers. But the flip side, it's similar to the low 1 on bar 13. The bulls buying yesterday's low know that it's a scalp. At least for now, it's a scalp, because it's still a tight bear channel. There's not enough buying pressure. The bulls are finally getting bull bars. We've had maybe 3 bull bars closing near their highs, fairly big bodies. That's good for the bulls, but we still need a trendline break. And we don't have a meaningful trendline break yet. So that's the problem with the bulls here. 20 is a strong bar, but it's right on the trend line. So you might have bears selling the close and bulls who bought yesterday's low scalping out. And then there were sellers above 20 on 21. Also, moving average test, and there were sellers there. But 21's a low 1 short setup after a strong bull bar, where there were just clearly more buyers at the low of yesterday than sellers. So the downside might be limited. There's probably buyers below bar 20. Also, remember I said on bar 12, there's less bulls buying above, but there's probably buyers below the bar. That's the same case with bar 20. If you're buying above bar 20, you're buying high in a tight trading range on the bear trend line. But if you're buying below bar 20, you're buying below a strong bull bar at support, yesterday's low. 22, bear breakout, but only a breakout of bar 21, and it immediately pulled back. The problem here for the bulls, there's still no major trend reversal setup. And for the bears, let me back up. For the bulls, as far as buying above 22, it's obviously a weak setup. Consecutive bear bars, weak signal bar, and in a tight trading range, forcing you to buy on a stop in the middle of a tight trading range after there hasn't been a meaningful trendline break. So the bears are holding short. They might sell above 23 or 22. The bulls, they still might buy below bar 20, but it depends on how the market gets there. 23 a bull bar. The bulls may be hoping it's a higher low major trend reversal, but I don't think they've done enough. Some might argue trendline break, retest of the lows, and then buy above 23. But that pattern is too small. That's about 4 bars after 20 bars down. The market needs to do more of a major trend reversal with more bars, more of a correction. So for now, 23 is still a minor reversal. Bears might exit above 23. We've had 1, 2, maybe 3 legs down, truncated wedge, and a bull bar closing basically on its high. '24, a bull trend bar, closing on its high and closing above the moving average, and there's a tick gap. 24 opened above the close of 23. That's good for the bulls. Plus, we're getting a trendline break. It's also good for the bulls, but at this point, it's still a minor reversal. And then follow through buying 25. Another tick gap from the close of 24 to the open of 25. The bars are uniform in size, so they're similar sized bars, with little overlap, strong closes, and a 4-bar microchannel, 3 consecutive bull bars. It's a respectable breakout. It's probably going to get a second leg. The problem with buying here, buying 25, you're buying high in a tight trading range. You're also buying the first major trend line break. Here's the bear trend. Bear trend with the trend line. We're getting a breakout of the trend line. But what happens? Now you could argue this was a final flag, maybe tight trading range continuation, and it failed, and this is the major reversal. But I think more likely we're getting the trend line break. We need a retest of the lows before any major reversal. But again, this is strong enough that the market's probably in a trading range. How many bear trends have strong bull breakouts? Of course, bear trends don't have strong bull breakouts. Disappointment bar for the bulls on 26. But it's a low one after a fairly strong breakout. Probably more buyers below looking for a second leg. But because this is a minor reversal, the second leg could be minor, and it could be as small as 1 bar. So bulls buying below 26, looking for a scalp. And instead, 27, they bought the close. 27, another bull trend bar, but overlapping 26 and testing resistance to the left. This is a bear breakout, pullback channel. Here's the start of the channel. Channels evolve into trading ranges. We're at the top of a trading range. Might be 1, pullback 2, pullback, 3 legs up. So there might be sellers above 27. And then another disappointing bar, 28. You can call 28 a high. You can call it a high 1 signal bar. It's an inside bar that reduces the probability for a breakout, and context is bad to be buying. I still think it's a bear trend within a trading range, but bear trend line break, we need a retest of the trend. The bear trend's low and some sort of double bottom before a major reversal. Now a second bear bar, 29, so consecutive bear bars. If a bull bought the close of 27, they're disappointed on 28 and even more disappointed 29. As far as buying above 29, I would not. I think there's more sellers above bar 29. It's a high 1, consecutive bear bars, bad context, high in a trading range. 30 could not get above 29. Instead, we had a tick gap. 30 opened 1 tick below the close of 29, pulled back, tested the open of 29, and then sold off and closed on its low below the moving average. Now the bulls have had 3 consecutive bars against them, with bar 30 being the strongest one. Bulls probably exit below bar 30, and bears might sell below, expecting a retest of the lows. I said this was a respectable breakout, and I still think it was, but when you think about the overall context, it happened within a trading range. It might be the minor reversal that breaks the trend line and creates a major trend reversal, but major trend reversals need a retest of the lows. It's lower probability for a bear trend to convert straight into a bull trend. So for a couple of reasons, there might be sellers, bulls exiting, and bears initiating shorts below bar 30. And then a little bit of a surprise on 31, but it made sense. It's a sell vacuum test of support. Now for the bull case, major trend reversal, who wants to buy after seeing 4 consecutive bear bars and a huge bear bar 31? You can argue it's a sell vacuum and there's more traders buying the close of 31. But we still haven't tested the low, and we may have to get there. Like I said, bulls might be waiting to buy below bar 20. And then a doji 32. Minimum follow through for the bears. So no one's buying above bar 32. Probably more sellers above. The bulls are looking for a weaker retest. This is too strong. They're looking for more buying pressure and a second reversal, and then a major trend reversal. But at this point, they don't have it. So we might go a little lower. 33, it's a bull bar, but it's an inside bar. So that's consecutive inside bars, an II pattern. So it's breakout mode. You might have some aggressive bulls buying above bar 33 because it is breakout mode in a possible major trend reversal environment, but strong enough down to bar 31 or 32, it's probably getting a second leg down. And because it's an inside bar, it reduces the probability for breakouts. And then you can see we did not trade above 33. Instead, we got the bear breakout. 34 bear trend bar, and it broke out below yesterday's low for a second time, so the bears are trying again. It would have been stronger if the market did not stall here, so we had a bear breakout, a pause, another breakout. And that's fine. For the bears, they still need to do more though. So 34, closing below yesterday's low, but closing at the same close as bar 19 and the open of 20. Would have been better if it closed below. The bears still need follow through. And then you can argue 35 is follow through. But can you see what the problem is? 35 closed above the low of the prior bar. And so it's a breakout bar, but it could not close below. So we have buyers into the close of 34, buyers into the close of 35. And why did 35 overlap 34 so much? If a bull bought below 33, scaled in lower, they were probably able to avoid a loss because of the tail on 35. That's a problem for the bear breakout. And then 36, finally a strong bear breakout bar, but it's accelerating. And I want to zoom out. Hopefully this doesn't, I didn't want it to do that. So if we zoom out, so a couple problems with bar 36. It's 2 legs down, so leg 1, pull back, leg 2. It's acceleration, which is a possible exhaustion gap rather than a measuring gap. You can argue 3 or 4 legs down, maybe 1, 2, 3, 4. So we're trying to get a breakout of a bear channel. But look at the overlap. Does this look like a strong bear trend? Of course not. If anything, it's a bear channel. And what does Al say about bear channels? You can think of them as bull flags. So higher probability of a bull breakout than a bear breakout of the channel line. So the problem with 36 is its acceleration, but it could be exhaustion. It could be the last of the weak bears selling and the last of the weak bulls panicking out. And then 37, terrible bar if you're a bear. If you finally sold on 36 and 37 is your entry bar, that's about the worst bar you can get. And so for the second time, we reversed up here. We're trying again to break below yesterday's low and reversing once again. 37 is a great bar for the bulls, but the context still isn't great. It's a tight bear channel here. And so, again, similar to 12 and 20, there's probably more buyers below bar 37 than above. The bulls need more buying pressure, and they need to at least go more sideways. And then minimum follow through for the bulls, 38. So that's good for the bulls. Bull breakout and follow through. The bulls are hoping we get a midday reversal. We've had maybe 2 legs down, maybe a wedge on a higher time frame. And they're hoping this is a couple legs down in a trading range. And so far for the bears trying to break out and create a bear trend below yesterday's low. It's not looking so good. 39, another bull bar, so 3 consecutive bull bars. That's good for the bulls. But the pullback here could be deep. If you're buying here, you're buying in the middle of a tight trading range. So more bulls might buy a deep pullback of this breakout. But 3-bar micro channel, good for the bulls. Plus you'd be buying right below the moving average. That's also not ideal. So we went outside down 40. Might be sellers below 40 for a scalp. But you had bears who sold. You have trapped bears below. Bears sold the close of 36. Bears sold above 36. That's where 40 is testing. And so, as far as selling below 40, it's really not ideal. You're testing a breakout point, and it's an outside bar. Outside bars are trading range bars. They're expanding triangles. So if you're selling 40, you're selling low in a trading range after a bull breakout. If you just think about what you're doing, it's not ideal. You can see what happened on 41. It's a bull bar. Did not trade below 40. Instead, we're going back to the upside. Bulls who want to buy below 37, it's looking like we're not testing lower. It's looking like bull breakout pullback. I'm going to draw this, make it more clear. You had bears. They see a strong bear bar 36. They sell above. They get trapped on 37 with follow through. They take 40 as a chance to exit, and that's exactly what they did. So now, as far as limit orders here, it's looking like we're not going there, at least not right now. And then where are we going? Well, the market looks like it's in a trading range. I did not mean to erase that one. Here's yesterday as well. Market's in a trading range, and if the market's in a trading range, gaps close. And what gaps? You had traders buying below. Again, this is a decent bull breakout. It was still a minor breakout because of the context, but strong enough to convert the market into a trading range, and it did. And so at this point, you had bulls buying below this breakout, buying below anywhere, and they got trapped on this bear reversal. So buying below 27, you got trapped. This is a breakout point. This is a magnet. And you can draw magnets really. Every price in here is a magnet. But the point is, if it's a trading range, the high of the trading range could be here. The high of the trading range could be here. It could be all the way up here. So I should have mentioned also on 37. 37 is an always in flip. And what I mean by that, aggressive bulls can buy above 37. And more importantly, for now, if you're short, you have to exit above 37. Even if you sold below 36, you have to get out above 37. 42. Bears, they might see it as a low 2. Low 1 below 36 triggered, immediately failed. And then 42, the low 2. Is it a low 2 at the moving average in a bear trend? I don't think so. I think it's a trading range. And I think we're getting a fairly strong reversal and a possible lower low major trend reversal. Let me draw it one more time. Bear trend, trend line break, test of the lows, we went lower, but double bottoms are rarely perfect. You can also call it a wedge, like I said earlier, on maybe the higher time frames. Trying to get a breakout of the channel line and then failed in a big way. So possible major trend reversal. The bull's looking for a rally to test maybe even the high of the day. Remember I said bar 20 remains the high of the day 20% of the time. If this is a reversal day, we could go all the way back up here. So I'll draw that as a magnet as well. Yesterday's high is really far. I'll just delete that one for now. But as far as 42, the low 2, there's probably more buyers below 42. And then we went outside up 43. It's not a good looking stop order market. The market's in the trading range. You have buyers below bars, but if you're buying above bars, you're buying high. Now, I still think we're going higher, but you're being forced to buy at a possible channel line where bulls are taking profits. So that's the problem with stop orders here. But 43, it's a good bar for the bulls. It's an outside bar. We'll probably retest lower prices like the high of 42. If a bear sold above 42, they'll probably be okay. This isn't racing up the way it was here, but it is channeling up, and there's not enough selling pressure for this to be a wedge top. In other words, if I'm long, I'm not too concerned about bar 40 and 42. I think 40 was a breakout pullback, and obviously bears got the heck out of there on the retest, and then 42 was obviously just a doji. So if anything, we might get a bull break out of this wedge and go for a measured move up. Going higher, 44, so if you did sell above 42, that's a problem. Now the market's channeling up, so bulls are taking profits above bars and buying below bars. So as far as buying here, it's not an ideal place, but the market is always in long. 45 going higher. Now 45 reminds me of bar 36. It's a great looking bar. It's a shaved bar, but that's parabolic. You're testing magnets to the left. You're testing where bulls got trapped earlier. Let's say a bull bought the close of 27. Not a great buy, but someone did, and if they did, they scaled in lower. Probably looking to exit here. So 45 might be a vacuum test of that price. And so disappointment on 46. Now 46 is an inside bar, so selling below 46, low probability anyway, but also tight bull channel, 3 consecutive bull bars, fairly strong, probably more buyers below. And as far as selling above, I would not. I think there's too much risk that the upside, we could be going all the way up here. 46 is not enough to shake bulls out. If this is a tight bull channel, it's a breakout on a higher time frame. And the bears need to get a better trendline break. They really haven't got one yet. 47, bull reversal bar. So we're triggering the buy above the inside bar, 46, which wasn't very strong, but now you have a high 1, 47, bull bar closing on its high. Bears are getting out above. Bulls are probably buying. And then 48, a bull breakout, but a deep pullback, closing below its midpoint. But do you really want to sell below 48? Of course not. It might be 3 legs up, 1, 2, 3, but your signal bar is a bull close and consecutive bull bars in a tight bull channel. Your only option is long or flat. Bear bar 49, but not enough of a trend line break. It's really a test of the trend line, and you might have more buyers on the close of 49 than sellers. And even if we do go lower, you have bulls scaling in lower. That's what happened on 50. Trend line, it's a minor trend line break. What I meant to say there was actually moving average test. So bear breakout, but a test of the moving average. It is a trend line break, but it's weak and immediately pulled back. And so bulls simply do this. And they're not too worried about it. And 51, continuing higher. Bull bar closing on its high. Bears, they might have argued it's a weak high 1, maybe a high 2. It's a double bottom with 46 and 50. And it's a doji signal bar, but the momentum is too strong. The bears haven't done enough to be selling. So 51, if you did sell, that's a problem. Inside bar 52. So lowers the probability for breakouts. Remember that it's a bull channel, so bulls are buying below bars and taking profits above bars. And that might have been here. Bulls buying below 49, buying below these bars. They get filled on 50. 51 trades above 49, they take profits. And that's the pause on 52. But 52 was not enough to be selling. It's not a major reversal. It's a weak minor reversal if we go below it. And 53, another bull bar, but it's a small bar at the top of the range. So bulls might be taking profits up here. We may pull back again, but if we do, it's probably minor. 54, outside down, but remember, outside bars are trading range bars. So if you're selling 54, you're selling low in a trading range in a bull channel near the trend line. So for a few reasons, it's not a wise thing to do. Probably buyers below scaling in lower. 55, bear breakout, but closing at the moving average. The bears still haven't done enough. This is not a major reversal. It's still a minor reversal. Trends get weaker as they go. So here's strong momentum. You can see we're starting to really channel up, but we are still channeling up. You can argue bull channel, bear flag, and that is true, but more likely this is still a double bottom until the bears get more selling pressure. Bulls are buying below 55, seeing it as a discount in a bull trend. They're saying the bears, they tried twice to get below yesterday's low. We got this rally. They're probably not undoing it here. Bears are hoping it's a double top, maybe even a wedge top. 14, 27, 48 maybe. 1, 2, 3. But since here, where's the selling pressure? A couple decent bars here, but above the moving average. And the bulls bought the close 55, moving average test. Huge bull bar and straight to the top of the range where I said bulls are taking profits. So that's the problem with a bar like 50, 56. Might be profit taking on the close. And then 57 pulled back. Whenever you get a trend bar, you're expecting 1 to 3 bars sideways. And so 57 was expected. But now 57, bears might argue wedge top, maybe 1, 2, 3, but not enough selling pressure, and 57 is a weak bar. It's small, it's a doji, probably buyers below, scaling in lower. And then if you did sell 57, 58 your entry bar, it's weak and disappointing, so bears might give up. Bulls still buying below. 56 was such a big bar, bulls don't want to buy the close. You're buying high in the channel, and you're just buying high on this bar. They might wait to buy a 50% pullback. Bull bar 59, triggering the high 1, but bad context, you're high in the channel, forcing you to buy high in the channel, but still always in long, so okay to be long, but you might have more traders taking profits in this area. Remember, bulls are buying below bars, selling above, so 57 low 1, but a weak low 1. They buy below, then we go to a new high, and they sell. And then there's profit taking, bar 60, we're pausing again. It's an inside bar, lowers the probability, so bear breakout unlikely, buyers below, and probably profit taking above, sellers above. 61 a bull trend bar, but now possible leg 1, pullback 2, pullback 3, might get a deeper pullback after 61, bulls taking profits at the top of the channel. And then you can see a little bit of a deeper pullback on 62, but still a minor reversal. I would not sell below 62. We might go a little lower. I think there's bull limit orders waiting to buy below, and you can see a breakout point here. Big bar 56, trapped bear selling above 55. Maybe we test here, but that's why the downside is limited. And then instead they bought the close 63, another bull trend bar. But if you're buying the close of 63, you have to know you're buying on the channel line. I'll just draw it. And that's the problem. That's why bulls buy below bars and take profits above. And then again, 64. It's the same thing repeating over and over. And you can see it all the way up. So 64, high 1, but channel line, so probably sellers above and buyers below. And we went above, but there were sellers above. Now we have a weak, bears might argue, micro double top, 63, and then 65, but a weak sell signal bar, buyers below. Instead, they bought the close. We had a tick gap from the open of 65 to the close, from the close of 65 to the open of 66. Traders are buying, but again, this line is like a magnet, and every time we touch it, we bounce off it, and bulls take profits. We're getting a bull breakout of the channel. That's a low probability event, so 67, low probability, but we have this magnet here. Now the market's always doing something to fool you. So if we have a bull breakout 67, it looks like a strong bar, but you still need follow through. So that's the problem. And 25% chance. In this case, maybe 30% chance this accelerates and goes higher, but more likely it will reverse within 5 bars and test the trend line. And where's the trend line? Might be here. The market was getting squeezed. It was wider over here. It's getting tighter and tighter. And there just wasn't enough selling pressure. And so that's why in this case, it's probably not a 25% chance of the bull breakout. It's probably higher. Might even be 40. I don't know. It might even be higher with the context. You have probably a reversal day here. And you have a magnet above the high of the day. So weak follow through for the bulls. 68, but possible breakout pullback. Test of the channel line. It's a weak bar to sell after a strong bull bar. It's a doji, probably buyers below. 69, disappointing if you did buy below, You can scale it lower, you're probably going to make money. But you can see, testing the trend line. So you probably have bulls buying below, but 69, big enough surprise, you'll probably get a second leg. 70, you can see the response at the trend line, and with the bear trend bar, traders bought. So bar 70, it's a bull bar closing on its high, but there might be a small second leg down, so there might be more limit order buyers at the close of 60, 69, and some bulls will buy above 70. It's a trend line test and a bull bar closing on its high with a magnet above. Weak entry bar if you bought above, and 60 or bar 71 might be the start of a second leg down. But it's a doji, so probably it's a weak signal bar. Buyers below, you have bears trapped on the 69 close, they're disappointed. Still always in long, but now getting close to the top of the range. So we might reach this magnet, but reverse when we get there. 72 bear breakout, but a breakout of one bar. So bear bar closing on its low, but you know there's bears disappointed with 70, looking to exit their shorts from the close of 69. This might be a vacuum test. It might be a breakout pullback, and then a second leg up for the bulls. 73, we went deeper than the close of 69, but at this point, some traders might see it as a wedge bull flag. It doesn't matter that the first push down happened before the high of the trend. All that matters is traders see 1, 2, 3 legs down. So 73, 3 consecutive bear bars, but 73 is the minimum for the bulls. It closed above its midpoint, so it's a buy reversal bar. So you can have stop order bulls buying above, looking for a test of the magnet. And then a decent entry bar from the bulls. 74 bull bar closing on its high, probably going at least a little higher. And then 75 more follow through, so the bulls break out 74, follow through 75. And 75 is a weak sell setup. The bears might argue it's a lower high. Maybe it's breakout mode. And a triangle, but consecutive bull bars with a magnet above. The selling pressure isn't great. There's not a major trend line break for the bull trend. So the bears haven't done enough. We're probably going higher. 76, same problem. It's a weak sell setup. There's probably more buyers below these bars. And then you can see what happened on 77. We fell below, found buyers below, and reversed up, closed near its high. 4 consecutive bull bars. Bears not enough selling pressure to sell, probably going higher. And then 78, pretty interesting what happened. You can see we raced up, tested the high of the day, actually made it so that bar 1 was not the high of the day, but right when we got there, everybody sold. So obviously the top of the trading range and a big response. Bulls sold out of longs and bears sold to initiate shorts. What about selling 78? I've said it a couple times today with outside bars. Outside bars are trading range bars. So if you're selling 78, you're selling low in a trading range. You're also selling where bears got trapped. Bears, some unlucky bear, sold the low tick of 70 and 73. So you've trapped bears below. And overall, it's a bull channel, most bars above the moving average. So selling here, not ideal. 79, inside bull bar. 78 was enough of a surprise to get a second leg. So we might go a little lower. And 79 is an inside bar, so lowers the probability for breakouts. Then another test up on bar 80, but immediately pulled back. The breakout immediately failed. 80 is a low 1 sell setup, but at support, it's a big bar, so big risk, bad trader's equation. Only one more bar in the day, but the reality is there's probably buyers below and probably disappointment for the bears. And then just a small bar, 81. For always in today, it was never very clear in the beginning of the day. Maybe by bar 7, it's always in short. But by the time you get, let's look at the context. When you get bar 12, you got to exit shorts above bar 12. Even though it's a tight channel, probably a second leg down. you're low in a trading range and you have a bull bar closing on its high. And when it's a trading range, you don't want to trade always in. You want to trade in a style that's more buy low, sell high. And if we're low in a trading range, you only want to look to buy. Did it become always in long here? Nope. Just look to the left. It's a tight trading range. You had one bar closing above here, but not even above bar 10, and that's really the start of the trading range. Spike, pullback, start of the channel, bear channel. Channels evolved into trading ranges, and we're testing the top of the trading range. So, on some time frame, maybe it became always in long, but what did I just say? When it's a trading range, always in is backwards. So if it's always in long, look to sell. You're high in the range. Is it always in short? Nope. It's getting closer to always in long. It might go a little lower, but you're getting low in the range. So buy low, sell high. But over here, I mentioned 37. Always in, bulls might buy above 37. Bears got to get out above 37. Possible lower low major trend reversal. It's a huge signal bar. The context is good for it. The overall higher time frame context is good for it. And when did it become always in long? Maybe around here. This is a breakout on a higher time frame. And with the context, probably going higher. So always in long, and really no reason to exit. 67, that's a reason to exit. You're getting acceleration at the end of a bull trend, and the bull trend is within a trading range. It's really a reversal day. You're testing near the top of the range. So 67 is what they call a gift bar. You suddenly have all this open profit. Your risk is big, and your reward, I don't know what's your reward, maybe the high of the day, but it's less reward than your risk. And there's probably sellers above, so that's a bar you can take profits on. And then that's about it for the day. It became a trading range in here, buy low, sell high. For stop order trades today, I thought bar 3 was okay. It's a second reversal down. Bear bar, strong bear bar 1, and then 3, and the context is decent, fairly high in a trading range. And then all the way down. If you argue it's always in short, you can sell below any bear bar, but again, hard to sell low in the range here. More of a limit order market because of the context. And then you might have had buyers above 23, but it's aggressive, and it's still not the major trend reversal setup. So any bull buying here is scalping. And what's the target? Top of the trading range, bar 10. And then I thought there were sellers below bar 30, reasonable stop order trade. But down here, again, low in the range. 37, I thought buyers above. And I mentioned in here, it's really a limit order market. Every time you're buying above a bar, you're forced to buy where bulls are taking profits. It's a bull channel, so bulls take profits above bars, and they buy below. So better to buy below bars and take profits above. So I thought the stop order trades were fairly limited. I thought you could have bought above 55. Maybe a double bottom bull flag. Obviously not the greatest signal bar, but you're expecting bears to get trapped here. So for stop orders, I thought that was about it. I don't know, maybe here even you scalp. You're getting not enough selling pressure for a reversal. You're getting a lot of bull bars with a magnet right above, and then they scalped out. For limit order trades today, bad high 1, maybe high 2 above bar 4. Thought there were sellers above there. Tight bear channel, sellers above any bar. Maybe not above 12, not ideal. Low 1 short. Below 13, I thought there were buyers below for a scalp. So then immediately you had sellers above 13. And then I thought buyers below 12, maybe below any bull bar. They came in here on bar 19. Buyers at the low of yesterday. And then you see on bar 20. 21, a low 1 short at the bottom of a trading range after a strong bull trend bar. Buyers below 21. Up here, top of the trading range. Strong bull breakout, but within a trading range. Minor reversal, expecting a retest of the bear trend's low, and you're testing the trading range high. So I thought sellers above 26. And then buyers at the low, below here, triggered here, but disappointing entry bar. Have to be willing to scale in lower, and then you can't panic out on 36. Buyers below here, buyers at the 36 high, breakout point, and then buyers below really any bar. This is a weak sell setup. Any bad stop order is a good limit order trade. And then bull channel, buyers below bars and sellers above bars, but sellers taking profits. Aggressive bears might be scalping. And where do we go tomorrow? Well, I mentioned at the beginning, possible 2 legs up, 1, pullback 2. This subdivided into 3, 1, pullback 2, pullback 3. The first reversal down was expected to fail, and it did, but now today became a high 1 setup, high 1 signal bar. We're far above the moving average. There's been a lot of overlap in here. This is a tight trading range, which is a magnet, and then a high 1. High 1s are high probability trades after strong breakouts early in the market cycle, and that's not what this context is. So I think if anything, probably sellers above today's high, and if we get above Wednesday's high, sellers above there too, and possible bear trend, maybe an outside down day, but I am expecting more sideways to down up here. All right. As always, please feel free to leave a question in the comments and include timestamps for any question specific to this video. And with that, I hope everyone has a good rest of their night. Thanks for watching.